I want to discuss the concept of translation exposure. Now, this refers to the effect that an unanticipated change in exchange rates will have on the consolidated financial reports of a multinational corporation, sometimes referred to as accounting exposure. Now, when you have a multinational corporation, they're going to have subsidiaries around the world, and those subsidiaries are going to have financial statements that are reported in the local currency. So they may be reported in euros or Swiss francs or yen, and for the multinational corporation to consolidate those financial reports, they're going to have to convert those back to, for example, if it's a U.S. company, back into dollars. Now, there are several translation methods. First is the current non-current method. And the underlying principle is that assets and liabilities should be translated based on their maturity. So current assets are translated at the spot rate or the current exchange rate. Non-current assets are translated at the historical rate in effect when the item was first recorded on the books. There's also the monetary non-monetary method. And the underlying principle is that monetary accounts have a similarity because their value represents a sum of money whose value changes as the exchange rate changes. All monetary balance sheet accounts, cash, marketable securities, accounts receivable, etc., of a foreign subsidiary are translated at the current exchange rate. All other non-monetary balance sheet accounts, owner's equity, land, etc., are translated at the historical exchange rate in effect when the account was first recorded. Then there's the temporal method. The underlying principle is that assets and liabilities should be translated based on how they are carried on the firm's books. Balance sheet accounts are translated at the current spot exchange rate if they're carried on the books at the current value. Items that are carried on the books at historical costs are translated at the historical exchange rates in effect at the time the firm placed the items on the books. And the final method is the current rate method. In this case, all balance sheet items, with the exception of stockholders' equity, are translated at the current exchange rate. So it's a very simple method in application. One shortcoming is that you have to have this plug in the equity account named cumulative translation adjustment in order for the balance sheet to balance. Let's take a look at an example here. So here we have a Swiss subsidiary, so they report in Swiss francs, SF, and we're going to have the exchange rate change from 3 Swiss francs per dollar to 2 Swiss francs per dollar. So the Swiss franc appreciated. And what you'll notice here is that you have different numbers in some of these different methods for doing the conversion based on what you're using. Okay, so in the first case with cash, if we look at this in Swiss francs, it's 2100. Okay, all the methods use the current rate or the spot rate of 2 Swiss francs per dollar, so they all convert to 1050. Now, if we look at inventory, we see some different numbers here. Now, note that the current value of the inventory is 1800, but they must report in the historical value of inventory at 1500. So in the current non-current method, they're converting this at the spot exchange rate, the current exchange rate. In the monetary non-monetary approach, since this is not a monetary item, this is a non-monetary item, they're using the historical exchange rate of 3 for 1, so 1500 divided by 3 is 500. In the temporal approach, they're taking the current value of the inventory and using the historical rate of 3, so they get 900. And then in the current rate method, they just simply use the current rate on the 1500. So you can see, and here the fixed assets are all converted at the historical rate, with the exception of the current rate method, where we use the current rate for everything except stockholders' equity. What you can see is this leads to different amounts of total assets, right, ranging from 2,550 to 3,300, depending on the translation method. So, this is an issue. I mean, as an analyst or somebody analyzing a company, you need to know what method they're using to translate their affiliates, financial statements. All right, let's take a look at some issues with hedging here. There are a couple of approaches you can take. One is a balance sheet hedge. And what this does is it eliminates the mismatch between net assets and net liabilities denominated in the same currency. If a firm has greater liabilities in euros than assets, they may choose to borrow in euros to eliminate the mismatch. So this allows the change in assets to be offset by a change in liabilities when exchange rates change. So you have exposure, but there's no risk involved, because when, if assets go down in value, so do liabilities. The problem with this is it may create transaction exposure, which I've discussed previously. This occurs if the new liability could not be covered by cash flows that are denominated in, for example, euros. So, for example, the U.S. firm's French affiliate does not generate sufficient cash flow to cover the euro debt. So then you have a transaction exposure problem. The other approach that can be taken is what's referred to as a derivatives hedge. So an example would be to use a forward contract with the maturity of the reporting period to attempt to manage the accounting numbers. Using a derivatives hedge to control translation exposure really involves speculation about foreign exchange rate changes. It involves, for example, using a forward contract to hedge potential equity loss in translation. And again, this can be a problem because, you have to sort of figure out in which direction you think the exchange rate is going to change. So, what's likely to happen to, the equity. So, one of the issues sometimes is, should you hedge at all? And that's an issue that some firms, especially if you have a bunch of different subsidiaries in different countries, it may not be such an issue. That, the appreciation of the dollar relative to the Swiss franc and in Switzerland may be offset by a depreciation of the dollar relative to the yen, in your Japanese subsidiary. So, there may not be a reason to do this hedging. That's something that's subject to debate.